Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, November 2nd, 5:48 p.m. Eastern Time. Coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. The confusion edition is what you might want to call it after the FOMC shenanigans today. Let's get into it. State of the market. Still in a correction from the standpoint that we're under the long-term 200-day moving average. We have been on a short-term uptrend, which now is highlighted in yellow instead of green after today's serious negative reversal. So basically, you could argue that the rally is on life support. Check over here on leaders, still showing bullish uptrend. There are still plenty of stocks above the 21-day exponential moving average, but we put the red arrow back on here after the big negative reversal today. It certainly signals caution from the seat that I'm sitting in. Short term, the 5 major indexes still above the 21-day moving averages with the exception of the NASDAQ, but actually no, the S&P 500 closed below it today too. So second close below it will be off of bullish tomorrow and to neutral. And then we'll see what the jobs report brings on Friday. Medium term, 50-day moving average lost by the S&P 500 again. The green arrow slid back further. The indices that were above there have pulled back quite a bit today, closer to their 50-day moving average, which is certainly an additional cause for concern. And long term, the Dow Jones Industrial Average gave up the 200-day moving average on the negative reversal today. So not a lot of good to say, and I'm generally a Jay Powell fan, but he did a really terrible job today between conflicting statements with the Fed statement that initially came out and was perceived as bullish, let's say dovish. There were comments about letting the lag, sometimes that there's a lag between the interest rates and how they trickle through to the economy. And there was an article that came out that said they already have the CPI data. So it was quite possible they got it on Tuesday. So it's quite possible that what they saw in CPI trickled through to the dovish Fed statement and Powell's opening statement. But then when the Q&A portion started, he turned a complete 180 and made several hawkish comments. The markets were up 1%. They had a serious negative reversal, closing down the S&P 2.5%, so a 3.5% outside negative reversal. And to me, the blame is squarely on his shoulders. For markets hate confusion. They can deal with things that they know, but when you go from we might slow a little bit, let the lag play out, to expect higher terminal rates, we're nowhere near done. Those are completely contrary statements, and he did a garbage job today. So you can see the red, very red, G6. This is our global 6 ETF composite down 3.4%, S&P down 2.5%, NASDAQ 100 down 3.4%, Dow Jones Industrial Average continues to outperform, down but only 1.6%. Mid caps down 2.9%, Russell 2000 small caps down 3.4%, Global Diversified 60/40 stock and bond down 1.3%. In-house, I hate losing. I don't care if we're losing less than the indices. I hate losing money. But down 1.8% approximately on the day. Let's get into our process here at Revere, and then we'll dive into the charts, crazy as they were today. So this here document is what drives us at Revere to be focus on defense, especially when you're under the 200-day moving average in the indices. We focus on downside protection and then let the gains take care of themselves when the market returns to a bullish posture, which it had off the bottom. That may have changed completely today with the harsh negative reversal, giving up 5 days worth of 6 days worth of gains. But if you get out of the way and you avoid these shaded bear markets, especially as you're approaching retirement, nobody wants to lose half of their nest egg just because either they or their advisor did not know how to get out of the way. The average of these severe losses is 44.5%. You need an 80% gain in the market to get back to even. January through October, this bear market was down a maximum of 27.5% high to low. You need 38% to get back to even, and things certainly didn't improve to today. But that's what we do, is focus on the downside at Revere, and I'll show you where and why we do, and what we consider a fully bullish market. Look back to last October, November, when the indices were trending above their short term. That's the green line, 21-day moving average, their medium term red line, 50-day moving average, the long-term black line, 200-day moving average. The market starts to roll over. Our stops will take us out. Sometimes there's false breakouts, which there were here, and then start rolling over again, which we did as the year changed. But then things got a little bit dicey because the slopes of the lines of the short-term 21-day and the medium-term 50-day started to roll over. This is when we really start paying attention. And then in the matter of a week, we broke the 200-day moving average. This is where all of those bear markets that I previously showed occur. They all occur under the 200-day moving average. So when you're under there, risk picks up immensely, and we ratchet up the defensive posture, either selling or completely hedging. Sometimes there'll be some false breakouts, which there were at the end of January and at the end of March. But things really changed for the worse on 4/21 of this year, where we tried to get back above the 200-day moving average, failed, had a negative reversal, and then the slope of that line turned over, and that kicked off the second leg down in the bear market. When do you get back in? We have short-term indicators to tell us when to do that. The most obvious one is a false breakdown, similar to what happened on 10/13. It also happened back here on 7/14. That kicked off a double-digit rally. We participated in this, but again, we failed at this declining 200-day moving average. A couple of minor rallies since then, and one that was going fairly well today, up over 10% low to high, but gave quite a bit of it back today, broke moving averages. Very clearly a distribution day, 90% down day. Not what we wanted to see. Let's go to the 1-minute chart here, and it's pretty clear from the 1-minute chart what we were talking about. So here you can see right at 2 o'clock, the statement comes out. It's perceived as dovish. They start talking about it on CNBC, discussing it, saying the bulls got exactly what they want. And it was kind of holding up pretty well. Then 2:30, the presser came out. Powell started off with a dovish statement. The market made new correction high or recovery highs intraday, and then right at 2:36, he started talking about higher terminal rates. We're not finished anywhere close to. Actually, we're not close to considering slowing was in this area here. We rallied a little bit, and then just the algos kicked in. When you just see no bounce whatsoever and just pure selling, this is the algos kicking in and just selling, getting everything that they can, and then we roll over and close at the lows. So there is normally a lot of shakeouts and false moves on Fed Day, but you can normally very often blame them on algos. I squarely blame this on Jay Powell for his contradictory statements. He had been pretty good. He messed up in, I think it was late 2018. Then he corrected himself with some statements that he made. He overshot on hawkish comments in 2018. He corrected himself. It kicked off a rally, clarified what the Fed was going to do. The market liked it, but they certainly didn't like being told one thing and then told another thing within 5 minutes, or I should say 35 minutes. Just complete garbage. So I don't normally get upset about stuff like this, but that was just a really trashy performance by him today. NASDAQ 100, the least healthy of the indexes, has been battling on the 21, never got above the 50, broke to 2-week lows here. This is awful performance. You can see relative strength making a new low before price. That tells you all you need to know about the big NASDAQ 100 stocks. Relative strength at a new low before price is a bearish signal. I also didn't mention how the stochastics have rolled over now. So what was in our favor is now not in our favor, with it's rolling over near overbought, because obviously can go a long way down from overbought to oversold. So that's an additional negative secondary indicator that we're dealing with now. Here's the Dow Jones Industrial Average. We took a long position in UDOW when we got above the 200-day, tested it and held. Got stopped on that today when we broke below the 200-day moving average. Stochastic hooking over in a negative fashion also. Mid caps and small caps have been leading. Didn't quite get above their 200-day moving average, but now we got to worry about them holding the 50 and the 21 after a big outside negative reversal. That was the mid caps. Here's the small caps. Same thing. Just holding on to the 50-day moving average. 21 flattening out now. It probably won't cross the 50-day moving average after that display. Let's go to the dollar. This had a lot to do with it today. You're going to see the 1-minute chart on the dollar, and it's basically completely opposite of what the indices did. Initially down on the comments, made new lows, then started to spike when Powell started to contradict himself. Outside positive reversal on the dollar is not a good sign for stocks. Undercut the 50-day, reclaim the 50 and the 21 today. That's bearish, and the stochastic hooked up. Let's go to TNX. This is the yield on the 10-year. Let's go intraday on it also, and you can see initial spike up, negative reversal, all the way back up to where it was with the initial spike. So rates higher too, holding the 21, challenged it several times. The stochastic is working on hooking up, but if rates continue back to go higher again, then that's another headwind for stocks. And with Powell indicating that it's too early to talk about pulling back on rates, that should give you a signal about what rates are going to do. You can see the TLT, which is the long-term bond, unable to get above on a price, unable to get above the 21. This makes new lows. That means at the 30-year, which is the 0TYX, 0TYX on Market Smith. That's the 30-year bond. That'll work to new highs also. The VIX, strangely today, traded in a tight range. Still below all of the moving averages, but consolidating here. It didn't break back above. Not sure exactly what that means. We are in oversold territory for the VIX, so that's another headwind for stocks. Let's take a look at gold. Initially spiked and then had a negative reversal. No reason to be in gold. And let's look at Bitcoin, because Dan likes me to talk about Bitcoin because a lot of people ask about it. So here's that 12. It's really a 1250 to 13. Again, shakeout moves there. Closed at lows, broke below this 1250. So that's a failed breakout now on Bitcoin, or maybe just holding on at 1240. You could argue it's 1240 to 1250 is a range, but that turned out to be what looks like a bear flag. Spike lower, spike higher, spike lower. Let's look at the G6 IWO here. You're going to see the same patterns on pretty much everything, but you're also seeing the stochastic rollover from overbought, failure at the 200, sitting right on the 21. This is component number 1 of the G6. Number 2 is FFTY. Same situation, failed at the 50, still above the 21. QQQJ, this is the mid-cap NASDAQ 100. Failed at the 50, closed below the 21. PDP, this is a momentum ETF. That has been the strongest, failed at the 200-day moving average, still above the 50 and the 21. MDYG, G. This is mid-cap growth, 200 mid-cap stocks, failed, broke the 50, sitting on the 21, and the granddaddy of them all, ARK K. ARK K, bear flag, failed at the 50, and this looks awful, but it does bring in SARK as a possible long that we'll be looking at tomorrow with the hold and the reclaim of all the moving averages and a positive stochastic cross. I got my alert set on that already. I got to put that in the 21 over 21 to make sure I don't overlook it. So let's do the tail of the tape now. Hope I'm not depressing anybody too much, but the truth hurts sometimes. So we still have the same macro headwinds. Only the NASI and RSI are still positive. Those usually lag before they hook down. But the indexes, the daily stochastic, the G6, the dollar and the TNX versus their 21, that's all negative now. Put call spiked to 1.21, so some fear did come in on the put call, although it didn't on the VIX. Fear and greed dropped 8 to 50. You can see I've got bull case here in yellow now from green as it's on life support. My comments, I've already covered these in the news. China had been rallying the last couple of days because there's rumors that they've got to relax their zero COVID policy because, well, it's just a stupid policy, and maybe they're being a little bit more realistic about that you can't completely have zero COVID, and the fact that the strains are way less deadly than the initial ones. ADP data came out early this morning that was strong. That's certainly not good for stocks. We'll see what the jobs report brings on Friday. Expectations neutral coming into today because of the binary event, very clearly negative now. We broke support on the S&P and the NASDAQ 100. Was focusing on the FOMC reaction, not any particular tickers. Well, I was focused on them, but it was just a boring day. You're not going to see a whole lot, but a lot of things that recent gaps higher had negative. Basically, everything had a negative reversal today. If you can find something that didn't, that's still holding up, good for you. But we probably have switched to a selling strength environment now, but maybe the jobs report on Friday, if it's extraordinarily weak, will give the bulls a goal line stand. So you can see we broke quite a few. Here's today, we broke quite a few formerly resistance turned support areas today. You can see the date with the negative arrow. The bottom line, Powell, Dovish statement, hawkish comments confused the market. Next level down is this 37.15 to 37.30 level. I'll talk about the buys and sells that we did in-house. As on that negative reversal, a bunch of our stops got triggered. And let me get this out of the way, and we'll go to some individual charts now. So what did we get stopped on? I already showed the Dow Jones Industrial Average, but let's take a look at it again. Our stop was the 200-day moving average. That got hit below the 200-day. We sold that. AEHR has been lagging since ON Semi and Wolf reported negative earnings. Got stopped on that as it broke the 21, so we're all out of that. Netflix went from a leader to a laggard on this recent pullback. Let's bring up the 60-minute chart. This, so here's the initial move up, the normal 2-day flag, which great. Strong move out of it with volume. This is what really made me think this thing might have some legs. Another pullback, another new high, a pullback, another new high. But then just nothing but selling. Early day strength, late day selling continually for 4 or 5 days in a row. And then when it broke below 280, we're stopped out. All these stops were for our 0.1% or less, with the exception of UDAO, that was 0.2. So our risk management worked. It's just you're dealing with a bipolar market, and like I said, I hate losing money, but you have to risk a little bit in order to make it. These are not risk-free entries. When we get back into the market, we're down about 1.5% since we re-entered the market. So there's Netflix. We got stopped on that. We got stopped on Enphase on the negative reversal. and we trimmed UPRO. UPRO was 15% position. We sold a third of that when it broke break even, which was around 37.60. We put a hedge on SPXS when we broke that 37.60 level. So our remaining, it's about 12% with the gains. Our remaining 12% UPRO is half hedged with SPXS, and the directional winner, we'll see who remains. If we, it's I got to look at some more charts tonight and what happens overnight in pre-market, but very possible that a move back up here into the declining 50-day moving average would be a spot to get back out, as I think the complexion of the market changed. Got a lot of thinking to do about exactly how to implement the plan going forward for what we have remaining. What we have remaining is we're either flat or have mid to high single digit gains on, and there's 4 of those left. PI, actually I think we're down about 0.1% on this. PI holding up extremely well, very clearly a leader, but this is one that the market may hold it back, and we may just have to sell and regroup and see what happens. HLIT rebounded very nicely today after yesterday's sell-off, sitting right on the 21. We are still positive on this, probably going to end up selling it if we go back below the 21. And volatility is in now, and with these wide ATR type stocks, they're tough to deal with when you have volatility in the market. Also, Cheniere holding up excellent. They've got earnings tomorrow morning. We have a 2% position on this with some gains. And Sting, day 2 higher high, acted fantastic early, higher high, pulled back right to this 50 level, very clearly being accumulated. Relative strength, new high, price at new high, everything going for it except for the market. But if there's one area of the market that can buck the trend of the overall market, we know that energy is the sector that is least correlated to the overall S&P 500. So what else do we need to cover? I think that's it. So as always, love to hear from you, positive, negative, or indifferent. And if you're going to watch the video and click that you don't like it on YouTube, for crying out loud, tell us why you don't like it. Don't just be an anonymous troll saying you don't like something and then we put a lot of work into this stuff. A lot of people benefit from it. If you don't, there's something in there you don't like, tell us what you don't like, man up, and we'll address it and discuss it like rational human beings. Don't just click the dislike button and move on with your life. And maybe I'm just letting that bother me more than I should, but that's the type of mood this market put me in today. I'm normally very smooth when it comes to these, but I just really don't like what Jay Powell did today. Anyway, we always want to hear from you. Don at revereasset.com or phone 855-REAL-WEALTH. That's 855-732-5932. I end every video and podcast with the same statement. It's not how much you make in the market, it's how much of it you can keep. We may be completely back in capital preservation mode again after today. Our stops get hit. We took our exposure down by 2/3 today. 0.34 is our remaining exposure, which is 34% of the overall S&P 500. We've got 4 stocks that are still holding up fine. But again, when you've got the market breezes blowing in your face, it's best to have discretion be the better part of valor. We've still got UPRO. The UPRO entry on the remaining remaining pieces that we have was 37.30. So less than 30 points to the downside here, but half of it's hedged, so we won't lose money on that unless we have a massive gap down tomorrow morning. That's going to wrap it. As always, like I say, it's not how much you make, it's how much you can keep. Thanks for listening. Have as good a day as you possibly can. Don Vandenbord wrapping up. Ugly Fed Day, November 2nd. Just the facts here. Painful as they may be sometime, but still just the facts, no opinions. Thanks for listening. Have a great day.